You work too hard for your salary to let it lose value just sitting in a bank app. Right now, leaving your cash in a standard savings account is the riskiest financial move you can ever make. Today, I am showing you the exact investment vehicle that smart professionals use to effortlessly preserve their capital and beat inflation: the money market fund. Welcome back to this space, your ultimate guide to building wealth and leveling up your financial discipline. Here's a quick reminder before we dive in. This video is strictly for educational purpose and it's not a financial advice. Let's get into it. To build your investment portfolio, you have to understand the macroeconomic machine running in the background. So let's look at the image that we have on the screen. As of February 2026, the CBN pushed the monetary policy rate to a massive 26.5%. This was done to fight historical inflation. Now let's look at the reality of the banking system. Commercial banks are happily charging up to 35% for loans, yet they are still handing you a miserable 3 to 4% on your standard savings. But here is the massive opportunity for educated investors like you and I. With inflation dropping to 15.06%, we have entered a very rare era of positive real interest rates. By using institutional money market funds, you can capture yields between 21% and 24% while actively outperforming inflation. So what exactly is a money market fund and how does it unlock these high rates that I talked about? Pay attention to the visual on the screen. A money market fund is simply a low-risk mutual fund that pulls together cash from thousands of individual retail investors like you and I. As a single individual, you may not be able to buy billions of naira worth of high-yielding wholesale debt securities, but these massive pooled portfolios can. The fund managers buy these premium assets, collect daily interest, and then distribute the profits directly back to you. Of course, they remove a tiny management fee. But this is the ultimate financial hack that you need to understand. You are getting institutional level returns, but with everyday retail convenience. I am sure whenever you see an investment that offers about 24%, your first question would be, is my capital safe? Let's look inside the investment engine and see exactly where your money goes. Look at the largest slice of this pie chart. 40 to 50% of the fund is locked in Nigerian treasury bills. These are backed by federal government, which means zero default risk, and they are currently yielding between 15 to over 20%. Now, another 25 to 35% is allocated to commercial papers. These short-term loans given only to blue chip corporations like MTN, Dangote, offering premium yields up to 25% under strict regulatory watch. Then the final 15 to 25% sits in fixed deposits within top-tier banks, ensuring that the funds have the deep, stable cash flow which is needed to process your withdrawal request every single day. So let's do something. We are going to put traditional banking head-to-head with a money market fund. Pay close attention to this table on your screen. Your savings account gives you 2 to 5% annually and it requires zero minimum entry. It gives you instant ATM access, but it actively erodes your money value against inflation. On the other hand, a money market fund delivers roughly 20 to 24% and it requires a tiny minimum entry of just 1,000 to 10,000 depending on which platform you are using, and it aggressively protects your purchasing power. Both of them share very low risk profile. The key takeaway here is the leverage that we see. Money market funds deliver 5 to 7 times the return of a basic savings account or the exact same level of capital preservation. The only trade-off here is that a brief 24 to 48 hour wait time is required before you can get your money from a money market fund. So because we are learning, we are trying to understand how the money market fund works. We need to understand the limitation of this kind of investment vehicle. First, recognize the interest rate risk. Your returns are not locked forever. If the CBN decides to cut that 26.50% interest rate, your money market fund yields will gradually adjust downwards over a 3 to 6 months window. Second, manage your liquidity buffer wisely because, like I said earlier, it takes up to 48 hours for a withdrawal to hit your bank account. So it's advisable you keep some money in the money market fund and save some for emergency in a standard savings account, of course. Finally, you need to understand that there is no explosive capital growth here. Money market funds will not double your money overnight like high-risk tech stocks or the blue chip companies. The entire goal is for capital preservation and steady compounding accruing interest. So let's put this together and apply it to a real world scenario. Let's say you leave 500,000 naira emergency fund untouched for exactly 1 year in 2026. So let's look at scenario A. In a 3% savings account, your balance grows to about 515,000 naira. But when we subtract the 15.10% inflation penalty, what happens? It strips away 75,500 naira in purchasing power. So the value of your money drops to about 439,500 naira. You have taken a net loss in this case because you earned a meager 3% in a 15% inflation economy. Now look at scenario B. Earning 22% in a money market fund grows your nominal balance to 610,000 naira. So even after factoring in the exact same inflation of 75,500 naira, your real purchasing power still rises to about 534,500 naira. So you have successfully preserved and genuinely grown your wealth at the same time. So are you ready to invest your money in a money market fund? I have here a 3-step action plan. Step 1, you need to look at all the platforms. Make sure that they are all SEC licensed fund managers. Don't just put your money just anywhere. You can choose the low barrier entries, you can choose the high barrier entries, whichever one suits your investment portfolio at the moment. Step 2, complete the digital onboarding. Just download the company app, fill out a basic KYC using your BVN and ID. You probably do not have to visit a branch before you get all of that done. Step 3, fund the account via a simple bank transfer, and then your money begins to accrue interest the very next day it lands in that money market fund account. And right away, your interest begins to compound automatically in the background without any daily effort from you. In an economy defined by massive central bank rates and double-digit inflation, like I said at the beginning, leaving your money idle is a financial mistake. Money market funds are the ultimate tool to transform you from a passive saver into an active earner. So review your portfolio today and see how you can leverage on money market fund today. The key takeaways I would like you to leave here with are: 1, with inflation rate at 15.06%, it is guaranteed you are going to lose your purchasing power if you keep saving all your money in a standard savings account all year round. 2, money market funds pool retail capital to unlock high yield wholesale assets like treasury bills and commercial papers. Initially, this was always reserved for billionaires and large corporations, but now it is open to you and I, retail investors. 3, money market funds offer 5 to 7 times the return of a traditional bank account, and it maintains the exact same low risk capital preservation. And finally, do not keep all your money in the money market fund. Reserve some emergency fund in the conventional or standard savings account just in case of an emergency. If you found this video useful, hit the like button, subscribe to Watch This Spaze, and let me know in the comment section which money market funds you are planning to use. Stay disciplined, and I'll see you in the next video. Cheers.